investors are looking for how to approach Trump 2.0. For more on this, I want to bring in Jay Pelosky, TPW Advisory's founder. Jay, I always love speaking with you because you have such a global view, but you also obviously look at what we're seeing domestically here. And you had that big capitulation on election night after the win of Trump, which you had not necessarily anticipated. How have you changed your outlook for 2025 in the months since we got that election result?
Yeah, thanks, Madison. Great to see you, and thanks for that reminder. That was a tough night. But look, as we see it, there's a lot going on. And right now, today even, you have an oversold condition in bonds. You have stocks that have flipped in a matter of weeks from being overbought with excessive enthusiasm to being oversold. Probably the worst 5 or 6 day run for the S&P in 50 or 60 years. You have a dollar that's overbought and seems to be wanting to break out. And then at the same time, you have commodities catching a bid, which is quite unusual. Dollar strength and commodity strength do not typically go together. And that last one for us is really, really important because our view is that we're in the early to mid stages of a long cycle, which we calculate from 2023 to 2027 or beyond. And that is really being driven by a complementary global growth cycle and a global equity bull market. And they reinforce each other by the earnings channel. And so if commodities are able to sustain a breakout, then that would reinforce this idea of a global growth recovery driven really by stimulus in Europe, led by Germany, which is facing stagnation. And then in Asia, led by China, which is facing deflation. And so we really see President-elect Trump as a positive policy catalyst abroad, going to reinforce the need for stimulus in Europe and in China, and kind of a chaos agent at home, as we've already seen with the attempts or the near closing of the government just a week or two ago. And we think that is being reflected in interest rates, which are up, almost 100 basis points. A lot of that due to concerns about the deficit and the economic policy mix under the president-elect.
It's such a fascinating view on the end of some of that global weakness that we have been seeing, Jay. Do you think that also comes alongside a waning of the U.S. exceptionalism that's seen the likes of record-breaking U.S. equity ETF inflows in 2024?
Yeah, you nailed it, Madison. I mean, that's exactly it, right? I mean, U.S. assets are priced for perfection. They trade at record valuation premiums versus the rest of the world, whether you're talking about stocks or the dollar. And we're completely, well, not completely, but very dependent on foreign inflows into the Treasury market. We have huge Treasury maturities that need to be rolled over in 2025. And so foreigners are more heavily invested than they've ever been in U.S. financial assets. U.S. investors are heavily invested, particularly in equities, and no one owns commodities. No one owns emerging markets. No one owns non-U.S. And so, yes, we are positioning for a shift in what has been a long-running trend since really the bottom in 2009, the great financial crisis. U.S. assets have outperformed, led by technology. Our view is that the U.S. story is going to start to deteriorate while the rest of the world is going to start improving their policy mix, again, led by Germany, which really has to act. We think they're going to act after they have a new election in the spring, and China, which is facing, a national security issue, arguably, where they have an export-dependent economy with President-elect Trump threatening 60% tariffs. They know that they have to stimulate domestic demand, and they are doing so in part to fight deflation. So there's a domestic policy process that encourages stimulus outside the U.S., and there's the fear of President-elect Trump reinforcing that. And that's why we say we view Trump as a positive policy catalyst abroad, and that's not a normal or consensus view. But we think that suggests that there's really an opportunity. And here's the point we want to really make. Year three in a bull market, and that's what we're in the U.S., year three, tends to be a kind of rest year, single-digit type returns. And so that's a perfect environment for non-U.S. to do well, because you and I both know when the U.S. is up 25% like last year, nobody cares about non-U.S. When the U.S. goes down 15%, everything goes down more. So a kind of quiet rest year where the U.S. can kind of catch up to the multiple expansion it's enjoyed in the last couple of years is perfect for the non-U.S. markets to kind of make a move. And so we're watching emerging markets very carefully, led by China, which, again, few people recognize and understand, but China large cap stocks actually outperformed the S&P in dollars in 2024.
It's a great point and a really important view to remind our viewers of, Jay, especially given the weakness we saw in China stocks to kick off the year, and also dollar China breaking through that 7.3 level for the first time since late 2023 this morning. We'll have to bring you back to talk all things China stocks next time, Jay. Thanks so much.
Thanks, Madison. Great to see you.